Brought down by bad mortgage investments, Lehman, which has 25,000 employees, will be liquidated.
The federal government loans American International Group, AIG, $85 billion.
This is a different kind of market, and the Fed is asleep.
The federal government is stepping in to stabilize Fannie Mae and Freddie Mac, the two mortgage giants that have been threatened by the housing crisis.
The Bank of England has pumped £75 billion more into Britain's ailing economy with a new round of quantitative easing.
You print a couple $1 trillion, and all of a sudden, people start to worry. So out of this worry, we have something called the Bitcoin.
Welcome to On the Brink. I'm Matt Walsh.
And I'm Nick Carter.
Massive technical difficulties today. So you have like dial-up internet, it turns out, at your home.
Yeah, at my parents' place. You'd think in the world of remote work that everyone would have good internet, but very much not the case.
Don't you find that there's like a thing where someone has bad internet and you're on a Zoom with them, it actually makes you like angry?
I mean, it's not great. It's like the Zoom etiquette is to have gigabit internet, I think.
Yeah, so we're recording this the janky way, so we're calling each other on the phone and recording it locally, so hopefully this works.
Yeah, I use Adobe Audition to record, and I was sounding like some sort of like monster from the deep before, so I think we're going to be okay.
Well, someone on our Twitter says that this gets the award for the most monotone podcast, and I for one, I don't appreciate that.
I mean, I think you have some vocal range. I think I'm dragging the average down in terms of the monotone.
Yeah, it's like, don't call me monotone, bro.
I concede the point.
I'm also getting some feedback that like maybe our audio levels are too low.
Yeah, so look, we're incorporating we're constantly learning. This is episode 271, I think, but it's never too late to make adjustments.
I mean, you have to respond to the coaching. So, I don't like the criticism, but we're responding to it. We're making shifts.
Yeah, my internal criticism is that we should change our intro song, because I've heard that song so many hundreds of times now.
People love that. People don't like it when we miss deals. I missed another deal last week. It's just getting to be, there's too many deals in this industry.
Well, we can't. Yeah, there was $35 billion deployed into crypto in 2021. $35 billion.
Guys, crypto is growing faster than the internet. We're trying to cover all of it. It's like covering the internet. It turned out to be a pretty big thing. Yeah, it's huge.
That's more than all other years combined. It is insane. So we can't do all the deals.
We're trying to do as many as we can. We had a busy week. I mean, this was just we'll get into it, but what a knife fight. People on Twitter, you had Jack and Mark Andreessen fighting. Mark Andreessen blocked Jack.
Yeah. You'd think Jack could just go in his sort of admin console and unblock himself. He probably has the God key, or maybe he lost the God key to Twitter when he stepped down.
Yeah, I don't think he has it anymore. Maybe it's nice to see Jack the Twitter user though.
Yeah, I like that he's kind of been unleashed. It's kind of refreshing.
So we'll get into that. This is the Christmas episode though, so I guess I'd be remiss if I didn't ask you if there was like anything on your Christmas list, or maybe we could do highlights of like what was the best Christmas present you ever got when you were a kid.
What's on my list? I think I just asked for workout gear this year.
You did? Nice.
Is what I asked Santa for. Yeah, like a Lulu gift card that would pretty much satisfy me, I think.
The Lulu men's pants are very comfortable.
Yeah, Lulu is a very underrated men's brand. Gotta admit that.
Yeah, very good brand.
So we were gonna do a section on what is the best Christmas gift you ever received.
Yeah, so I'll tell you mine, and it was electric football. And this might be, people might not actually know what this is, but electric football is basically like a cookie sheet, and you'd plug it into the wall, and you'd line up these football players on it, and you'd run plays. And it never worked. They just like went everywhere. It probably makes no sense to even describe this to people. And it would not have existed if the internet worked. But I probably conservatively spent 2 to 3 hours a day the month after I got that game playing electric football.
But what was the point of electrifying it?
Well, because the guys moved. You turned on the electricity and like it was like they were running plays, and then you had to simulate throwing the football to one of them. So there was all sorts of breaks in the action where you'd throw and kick. I can't believe it was a thing. It didn't really make sense. Never worked.
I don't understand how you can simulate football in an analog manner. I mean, how does the game keep track of where the ball is, for instance?
It was kind of an inferior version of tabletop hockey, which at least was interactive. And that's probably my second best gift ever, is the tabletop hockey.
So that tabletop hockey is like foosball, but with hockey players. Like that I understand.
Yeah. The only downside of that is that you need someone to play it with, right? So if like your brother doesn't want to play, you're kind of screwed.
Yeah, I had sisters, so I never had anyone to play with. I read books.
I was going to say, I'm surprised that you didn't just jump out and say the best gift you ever received was a book.
I have enjoyed many books. I think if I had to pick one, I would say I really enjoyed various like mechanical flying devices, that I received, planes, gliders, like electric, wind up like mechanical birds. I was really into that kind of stuff as a kid.
Those gliders were great. Those balsa wood things.
Oh, big time. Yeah. I used to manufacture those. It's a lost art. I don't know if kids these days, they're just all about TikTok. I don't know if they've ever experienced building a glider out of glue and balsa wood.
Now, these kids out there, they're getting like Amazon gift cards and Roblox stuff. It's like, have you ever been bored? These kids don't know how to be bored.
Yeah, they're just getting NFTs and in-game items, metaverse property.
Well, you had a busy week this week. You and Lucas from Coinmetrics wrote a piece for Bitcoin Magazine around why Bitcoin's proof of work is still well worth its fees.
Yeah, I don't know if I'm actually surprised we didn't get any pushback on this yet. But basically, it was in response to a claim that actually FTX had made about how proof of work blockchains are sort of inherently high fee. And that's just not really the nature of the relationship. I mean, certainly Bitcoin and Ether are the high fee blockchains, but that's not because it's proof of work. That's just because they produce less block space. So we were basically explaining where fees come from in a blockchain context.
I thought that was a good piece. The other thing you did this week was sitting down with Anders Larsen. He's from US Bitcoin Corp, talking about how miners make decisions, talking about how they allocate capital. So nice to see Anders in the space. Guy was, I feel like he was trying to figure out if he'd go full-time crypto for a couple of years, and now it's great to see him all in.
Yeah, that's right. So Anders, we talked about this on the podcast, so I'm not doxing him or anything. Anders and Derek Sue were actually roommates at Wharton. Derek obviously then went to Blockchain Capital and now Reverie. And Anders is now helming crypto investments at Cavalry and also is the CFO of this miner. So pretty powerful group. That Wharton class of 2018, I think Yassine was also part of that same class. So it was a really successful class of crypto entrepreneurs.
There's a couple other crypto entrepreneurs that year too. It's just an unbelievable class. It was like the the 1999 Miami Hurricanes football team, just like one of those type of classes.
That reference is lost on me, but I get the gist of it.
Yeah, it's like really good players.
So I want to talk about this web3 beef, but maybe let's do the deals first.
Well, let's do the deals, and then that's the big story of the week is the beef. So let's start it out in the Castle Island portfolio, Arcade, which is an NFT financial services company. So they'll give you a US dollar loan against Bitcoin collateral. They also have an OTC desk. Really excited about this one. So they raised $15 million from Pantera, from us, from Franklin Templeton, from BlockFi founder Zach Prince, and from others. Really excited. Congrats to the Arcade team.
Love to announce Castle Island deals on the show. Next up, we have Figment, their blockchain node infrastructure company. They raised $100 million in a monster Series C led by, is that Thomas or is that Thomas?
This is what I love about crypto, Thoma Bravo, which is like one of the best private equity firms out there venturing into crypto. No one knows who they are in crypto.
Yeah, including me. So that's just Toma? Then?
Toma Bravo. He's great.
Okay. All right. Okay.
Great firm. Big Bitcoin fan.
There. So Figment was led by Toma Bravo, firm I just found out about, with participation from Morgan Stanley's Counterpoint Global, Binance, Parify, Fidelity's Avon, Bitstamp, and Franklin Templeton.
Figment, just an awesome company. So congrats to Lauren and the team over there. That's a great raise. Next one is Gear Technologies. This is a smart contract platform. They're building it on top of Polkadot. They raised $12 million from Blockchain, 3 Arrows, Lemniscap, and DG.
Next up, we have Galoy, which is because you call them a developer of Bitcoin banking software. They are the startup behind the Bitcoin Beach wallet, actually, in El Salvador. They raised $3 million from Craft Ventures, Kingsway, Trammell Venture Partners, and Balaji Srinivasan. Congrats to Galoy. Another Miami startup. Shout out Miami.
Well, that's the one I missed last week.
Oh, was it? Okay, we missed Galoy.
Yeah, we missed Galoy.
Our bad.
Sorry, Galoy. Next one up is Multichain, which is, I'm surprised that name had not been taken. That is a company, the former name was AnySwap. It's a cross-chain protocol. They raised $60 million from a lot of people. Binance, Sequoia China, IDG, 3 Arrows, Defiance, Circle Ventures, Tron, Hypersphere, Primitive, Magic Ventures, and Hashkey.
Next up, we have actually Kraken acquired Staked, which was a non-custodial staking platform for an undisclosed sum, but apparently one of the, quote, largest crypto acquisitions to date. So congrats to the team.
Yeah, I think this was a big deal. So congrats to the Stake team. I mean, it makes a lot of sense. Coinbase buying Bison Trails, Kraken here coming out and buying Stake. So congrats to the Stake team. Sounds like it was a great outcome. Next one is Render Network. This is a decentralized 3D rendering company. They raised $30 million from Multicoin, Alameda, and the Solana Foundation.
And lastly, we have Memento NFT, a direct-to-fan NFT platform. They raised $4 million from Cadenza Ventures, FTX, Animoca, and Mark Pincus.
All right, so what do you want to get into first here? You want to talk about the Jack Dorsey beef of the week?
Yeah, why not? So Jack is no longer the CEO of Twitter. He stepped down. He still runs Square, though, right? So it's not like he's retired. And Twitter has been all aflutter with his sort of tweets, which have been interpreted as against web3, I guess. And in particular, he seems to be turning his cannons at A16Z. But he certainly had some provocative tweets recently. I think probably the one that kicked it off was, quote, "You don't own Web3. The VCs and their LPs do. It will never escape their incentives. It's ultimately a centralized entity with a different label. Know what you're getting into."
Yeah. He's been going really hard after Dixon and Mark Andreessen. I mean, some salty tweets, and Andreessen actually blocked him, it looks like.
Yeah, you'd think that he could just go into his admin dashboard on Twitter and unblock himself.
So why don't we just stand up both sides of this argument here? I mean, I think this is actually whether you agree with Jack or not, and he's really getting at some of the key tension here in the industry around Web3 and who actually owns this. So why don't you take a shot at just like steelmanning Jack's argument here?
Yeah, and we were actually arguing before the show. I think you're probably more on the Andreessen side, and I'm probably more on the Jack Dorsey side.
Yeah, I think
to the extent I understand it.
Yeah, but I think there's it does feel like some people are just talking past each other here, actually.
That's possible. So maybe I'll try and steelman his argument. I think Jack clearly believes in decentralized internet infrastructure. He's a supporter of Lightning. He's financing or at least Twitter has this initiative, Blue Sky, which is meant to be for decentralized social media, which is pretty cool to see a centralized social media company working on that. And then he's trying to build a DEX, decentralized exchange for Bitcoin. So there's no question about his sort of credentials in terms of, I would say, believing in and investing in decentralized internet infrastructure. And I don't think it's a paradox or a contradiction that he, founded Twitter and Square, which are web2 companies, so to speak, to the extent that he is actually demonstrating praxis with Web3 or whatever, decentralized internet services. He clearly believes in that stuff. So then what I believe the crux of his critique is basically the claim that to the extent, Web3 services are owned by token holders, and to the extent that large venture firms gain significant allocations, then it's a little bit paradoxical that you would have, effectively the status quo in this new domain. Whereas if you're looking at truly user-owned infrastructure and services, you would imagine that wouldn't necessarily involve sort of like powerful internet oligarchs. And so I think maybe that's sort of the main thrust of his critique.
So, all right. So I get that. Now, I think if you were to look at the other side of the argument here, and again, it's hard to know because Jack hasn't come out and said, here's what I think, and here's how this should work, or I have this, and this point of view. So it's hard to know. He's just kind of taking shots at, hey, Andreessen owns a lot of this. And look, Andreessen's the biggest fund in the industry, and there's a bunch of stuff that entrepreneurs are trying to build, and they need capital to do it, and Andreessen's there. And so I guess my first point would be, yeah, it would be great if users owned all of this and there weren't venture funds that were going out and owning 10, 20, 30% of these networks. But the SEC has not made that possible. And so, rewind to the ICO days, that's a Wild West securities fraud situation. I don't know how you get these tokens into people's hands without raising capital some way. And so it's just an unavoidable thing that if you're building something that has already not been spawned into existence, like Bitcoin, a decentralized file storage network, if you're building a decentralized compute network, you're going to need to raise some money for it, and you're going to probably go to the venture capitalists. So I guess what would you say to that?
Yeah, I agree. And I think it's probably utopian to think that you can allocate capital at scale without professional capital allocators coming in and doing it, because that's their job. And that's just the way society is organized. You have specialists. VCs are mechanisms to allocate risk capital at the early stage. I think there's two questions there, though. One, does decentralized internet architecture entail or require a token? Like, does Web3 mean tokenization of all protocols and applications? Does it, is that inherent, or is it something that could be tokenless? And then two, to the extent that you're engaging, and this is a classic critique of crypto as well, I'd say, to the extent you're engaging in disintermediation and cutting out rent extracting intermediaries and potentially obliterating, corporate margins and returning the remainder to users as a consumer surplus, is that investable? And is the fact that it's perceived as investable by, large capital allocators, does that mean that it's not as egalitarian as it is kind of described?
Yeah. So there's a couple things to dive deeper on in what you just said. So do you need tokens for these things is the first. And the second is, how should value accrue to some of these networks? So I think the first...
Well, the second is is there a paradox here if we're talking about user-owned services, but then saying there's necessarily corporate wrapper around these services.
Yeah, or there's just like rent extraction, not necessarily that there's a corporate wrapper, but there's a community-owned network that takes a fee that has like revenues associated to a protocol.
Yeah, so feel free to address those in turn.
Yeah, so I guess, I don't know, though, like, do you need a token for it? I'd say we probably need fewer tokens than people think, but there will probably be many more tokens than exist now, if that makes sense. So like more tokens are coming, but we don't need as many as people think. And there's a lot of this infrastructure that actually would work just fine without a token, where the token is actually a gating inhibitor to people using the product. Like it induces a friction that actually makes it less likely that mainstream normal people will want to use these things. And most people actually want to denominate their life in dollars. And so my guess is that a lot of these services end up just using stable coins. And to the extent that there's a token engagement, it will all happen below the browser hood. And people won't even know that there's a token, which sort of gets to your second point around how much rent can you actually extract from these things. And it's probably in some categories, it's a non-zero amount of rent, but it's not sufficient that these tokens should be valuable to the extent that like Ethereum is valuable. So it's a non-zero amount, but it's not competing to be like a smart contract platform, Android for crypto, iOS for crypto. There's a world where many of these things work and they just don't accrue a lot of value at the token layer.
So here's my question about token-enabled internet platforms, whereby, the grand vision I see laid out a lot is, hey, if you made all of the users of the network shareholders in the network, now they're actually being compensated. It's not uncompensated labor where they contribute their data and their time, etc., to the network. They actually get the fruits of their labor. So my question is, how does it make sense to allocate a lot of tokens to users that are sort of initial early users? Because that's kind of what I've seen to date. Whereas most of the users of these networks, by definition, are the late adopters. So wouldn't you expect to see more experimentation in models such that it's only a trickle of tokens actually initially, and there's not that extravagant returns from being an early adopter, and then it's a flood of tokens that actually scales with the growth of the network, such that the late adopters aren't totally disempowered?
Yeah,
that's kind of what I would have expected or hoped to see, because if you want people to use the network because the network has value, as opposed to merely just speculating on the value of the network. And it's also pretty inegalitarian to the extent you can control the supply schedule to make it such that early adopters really financially benefit. So wouldn't you want to see more like reverse tapered models of token distribution?
100%. I think that this is a space that will evolve tremendously over time. I mean, right now, the way that you get tokens in the hands of people, we're in like month 9 of the experimentation of like things that are actually possible here. I feel like you have the yield farming just existed for the first time in 2021. And so I think people will experiment with this. I think, what was that, the WorldCoin thing? Like that's in the category of just experimenting with novel distribution events. And no one has the right answer to that, to be clear. Like, how would you actually design that? It's like future users will always be able to gamify that in some interesting way. But my guess is that someone comes up with something, but it's very difficult to imagine an immaculate conception event like Bitcoin ever being possible again. You look at Gree as a fair launch, and people tried to game that immediately. I mean, people were out there trying to mine as much as they could. So it's hard to imagine an egalitarian distribution from scratch. So it'll always be flawed.
Yeah, so that's where I'd like to see experimentation. I think that might also appease some of the Web3 critics to a certain extent. Basically a model where it's not so obvious that early extractors are sort of financially benefiting, at the expense of late adopters. And I think you can probably devise rules that support that. But I do think that drives a lot of the critique of crypto, which is like, even if you're building really great products and services, there is always this like MLM type dynamic where you can financially benefit from being early, which introduces like perverse incentives, I would say, into a lot of internet networks. Like, you don't want your early adopters necessarily to be mercenaries and speculators. Like, it also obscures, genuine traction too. Like, if you are building a social network or something similar and you are, distributing network equity to early contributors, you're not going to know whether your network has traction organically or whether the traction is subsidized. So, it also makes the signal noisier, I think. I'm actually seeing people turn against, liquidity mining a little bit, because it is a great way to inject attention into your thing, but then it leaves you in this like tough situation where you don't know what the equilibrium is going to be like once that incentive is withdrawn.
Yeah, no, that's exactly right. The other thing, just on the Andreessen specific point, is like, they're not going to own 30% of these networks 10 years from now. They're investing out of 10-year funds where they need to distribute back to LPs. And so they're going, like, the Gini coefficient will improve here. And maybe that's understood already, but it's, there's sort of this portrayal here that like the big bad VCs are just going to own 20% of the internet forever. And that's just not the case.
Yeah. Maybe this is a bit of a self-interested take, but yeah, there's good and bad, right? So VCs by mandate have to exit their positions for the most part, unless they do in-kind distributions to their LPs, which kind of means that they have to eventually reduce their ownership in some network or protocol over time. I think the thing you should be afraid of, maybe, if you were worried about the, inegalitarian nature of early adopters, would be some sort of non-LP capital and, like a solo proprietary capital entity, buying a large share of some protocol equity and holding on to it forever.
Yeah.
But the other flip side to that VC incentive thing is they have to sell. And so, that's what it accuses people of, like, quote unquote VC dumping, is like by mandate, they sort of have to sell.
Yeah. You can't hold on to these things for 20 years. You can distribute them in kind to your LPs, but it's 10-year fund life for a lot of these vehicles.
Let's take a quick break to talk about our sponsors. Now, on this show, we only really like to work with sponsors that we actually know and can recommend. And both sponsors today are great examples of that. So our first sponsor for this episode is Withum. They're a top 25 accounting firm with a cutting-edge digital technology and blockchain practice. So wherever your company is, from pre-seed to IPO, they have tailored solutions just for you. They've helped some of the largest companies in the crypto industry with audit, tax, and advisory needs, and they've also helped some of our portfolio companies too. To learn more about their advisory, audit, and tax services, go to onthebrink.link/withum. That's onthebrink.link/withum. If you manage corporate or institutional funds, you're probably looking for ways to access opportunities in crypto. You see the growth and momentum and want exposure. But a lot of institutions don't know how or aren't comfortable with the risks of Bitcoin or DeFi. Now there's a new investment that's built specifically to help institutions get into digital assets. Meet Circle Yield. It's a blockchain-based investment built with USDC, the leading dollar digital currency. Circle Yield is fully secured and over-collateralized with Bitcoin to protect your funds. This also makes it a great fit for crypto institutions who want to diversify their treasuries and reduce risks while staying on-chain. You get your choice of terms from 1 to 12 months and a fixed rate that's higher than what you'll get at a bank or in many fixed income markets. Visit circle.com/yield to book a meeting with one of their experts. That's circle.com/yield.
The other kind of interesting thing here was, you probably didn't hear this, but Jason Calacanis came out with a podcast last night, and he was talking about it on his This Week in Startups Roundup. And he suggested actually that the reason why Jack has such a beef with Andreessen is because Andreessen was in talks to do a leveraged buyout of Twitter, which I had never heard that before. That would have been fascinating.
Yeah, because it seems like a lot of his ire is directed at Andreessen specifically.
Yeah, I mean, better them than Castle Island, to be honest with
you. So here's the good news around the Jack Dorsey versus everyone else beef. I tweeted something that both Balaji Srinivasan and Jack retweeted about Web3, which means that they actually have common ground.
How do you thread a needle like that? That's just a crazy needle to thread.
I don't know. I'm impressed. So I was just saying generically positive things about Web3 that were sufficiently inoffensive. Yeah, so there is common ground somewhere.
Well, you can unite both sides. Maybe that'll be the takeaway here, is that, there's a lot of people throwing rocks at each other on Twitter, but maybe you can be the mediator.
So my challenge to the Web3 combatants would be to try and define Web3 before jumping into the hot takes, because I find that it's so poorly defined that people completely talk past each other. Like when you talk about Web3, you're talking about users using public key infrastructures to sign in to internet services. Are you talking about users running their own servers? Are we talking about users literally owning network equity in the internet applications they use? Are we talking about Ethereum? Because like Web3 had this big Ethereum connotation. So like what Web3 are we talking about when we talk about Web3?
I think we should just call it what we call it, decentralized internet architecture. Let's get that going. Andreessen's playing this Web3. They're winning the marketing war.
Yeah, that's just as catchy. I mean, I like the D-Web.
The D-Web, yeah, you were pushing that for a while. That didn't catch on. I was trying to call DeFi programmable finance. That didn't catch on. We're not good at like that. Yeah, we're not good at that.
We tried to rebrand stablecoins to crypto dollars. That didn't work.
It didn't go. Yeah, it didn't go.
We have a long history of failing to rebrand stuff.
All right. Well, that was the Jack Dorsey take. I think we got out of that alive. We'll see. Let's talk about some news this week. So Cynthia Lummis, senator from Wyoming, definitely my favorite senator, I would say. Not because of her political affiliation, just because she's a huge supporter of the cryptocurrency industry. So there is a bunch of leaks coming out, definitely from her office, that she will introduce a bill next year. It's going to create a new regulatory body for cryptocurrency. So Gary Gensler will not like that. And supposedly she wants, quote, nothing short of a full normalization for digital assets in the United States. That sounds pretty awesome to me.
You absolutely love to see that. Like, legalize crypto.
Just put it like normal, just another asset. That sounds like the most common sense thing I've ever heard. And actually take it away from the SEC, which has just been bungling this thing for the past 5 years.
Wow, I just had an idea for merch.
Oh, yeah? What do you got?
Oh, yeah, just a hat that says legalize crypto, or possibly legalize Bitcoin. Or right, maybe legalize it and then crypto in parentheses. We'll figure it out. Don't worry.
We'll workshop that.
I'm wearing our merch right now. I'm wearing the Bitcoin flag hat, which is of my design. Very happy with it. I believe that's available on the store.
I got some stocking stuffers off of the store.
It's very handy having your own merch store because you can just design into existence merch that you want to wear.
Yeah, I mean, you just build what you want. And some of the stuff that I want, you rudely took down.
Oh, yeah, that's right. So this bill, the Lummis bill, I believe, we'll see, I've heard whispers that it might actually have bipartisan support. And, there's like some crazy thing, like 98% of bills never even, get out of committee or whatever. Most bills, by far the overwhelming majority of bills, don't become law. And so a lot of bills are just like a way for senators and representatives to sort of make their feelings known, and they sort of communicate in bill format. It's like their version of tweeting, I guess. But apparently this bill is understood to be pretty serious. So high hopes for the Lummis bill.
This is a nonpartisan podcast, and I am not affiliated with either party, for the record. I've voted for both sides, so I'll just get that out of the way. But
big both sides guy, are you?
I'm a both sides, middle of the aisle guy, and I'll just say Elizabeth Warren, who's our senator, will probably not be voting for this bill. And she came out with a tweet this week that is just so ridiculous. Giant grocery store chains force high food prices onto American families while rewarding executives and investors with lavish bonuses and stock buybacks. I'm demanding they answer for putting corporate profits over consumers and workers during the pandemic. This is like a 5% margin industry. And it has not changed. It has not changed over the past like 30 years. So it's a lot easier to just get out there and bang the drum against big poultry and big grocery. But, the issue is the big Fed balance sheet, Elizabeth, and that's not a great soundbite, I guess.
Yeah, I posted a doctored version of the CPI chart where I rebranded it as Liz's index of corporate greed.
I saw that.
Basically, this is one of those weird things that you see is like when inflation picks up, people that want to obscure the underlying causes of inflation, namely enormous government spending and monetization of the debt, blame it on other stuff. And so Liz is blaming it on corporate greed. So it's just, her theory is that there was all of a sudden a complete uptick in corporate greed on a broad basis all across the economy, in all sectors of the economy. And grocery stores were, 2% greedy last year, but they're 8% greedy this year.
Yeah.
And in the 70s, they were 20% greedy.
Because Stop and Shop really has that pricing power, right? So you can mark up bananas to 50% margin, and that actually works. Like, are you kidding me?
Yeah, like of all the industries to go after, like some of the most hyper-competitive ones with the thinnest margins does not seem to be like feels like the wrong culprits. But anyway, so I'm projecting another 10% corporate greed next year, that's for sure, especially if this Build Back Better bill is salvaged.
Yeah, it wouldn't be the craziest thing. All right, so let's move on. Here's a fun story. The Radioshake is back. I don't know if you remember that company, but I used to go to Radioshake back in the day. Used to be very popular in the South Shore Plaza shopping mall. Two men that bought Radioshake, which did go bankrupt, they're launching a DeFi project with the Radioshake brand name. So as one does.
Yeah, this is similar to sort of a Kodak coin situation where there's nothing left of the corporate entity except for the brand. And so it's now being exploited for, I guess, token issuance purposes, which is really a shame. Radioshake was actually a treasured institution. It was kind of the only place you could go to get extremely specific electronic parts on short notice, at the mall. It was kind of an incredible thing that it lasted so long, and I miss it, frankly.
I do too.
It's a shame to see its corpse kind of defiled in this way.
Do you remember the 2-inch black and white TVs they had, the portable TVs? Those things were incredible.
Yeah, I spent many long hours at Radioshake in my younger days. So yeah, to be clear, like I'm not bullish on whatever this token is, nor do I think Radioshake is, the key to unlocking DeFi or whatever. So we've been asked to opine on a certain paper that was written up in the WSJ recently. This is sort of new FUD just dropped, and it's this paper.
All right, yeah, so let's get into it. It's that too few people own too much Bitcoin, right?
Yeah, this is a classic FUD. Is this even on any of the dice, like inequality? Oh yeah, it is.
Yeah,
I think we
Gini.
have Ginny. Yeah, we got Ginny on there. Yeah, so a lot of people didn't know what the Ginny panel was on the FUD dice. Now you know. So basically, classic FUD that Bitcoin ownership is too concentrated. So there's paper or article in the WSJ named with a headline, Bitcoin's 1% controls lion's share of the cryptocurrency's wealth. Paul Vigna wrote it. Disappointed in you, Paul. And then the paper is an NBER working paper entitled Blockchain Analysis of the Bitcoin Market, which is actually like pretty good, I would say. So I did go to the source. I did read the paper for you all. Don't worry, Brink Nation. We got this thing covered.
All right, let's get into it.
So the headline from the headline from the article is basically, summarizing the paper. They say the study found that the top 10,000 Bitcoin accounts hold 5 million Bitcoins, with an estimated 114 million people globally holding the cryptocurrency. That means approximately 0.01 of Bitcoin holders control 27% of Bitcoin in circulation. And then the rest of the article is basically complaining about that and how unequal and inegalitarian Bitcoin is. Those nasty Bitcoiners, they're hoarding up all of the world's wealth.
Did you get into the methodology around how they address wallets? Because obviously, if you just look at the Coinbase wallet, there's a lot of people behind that one address.
Yeah. So the paper is actually, I would say, reasonably diligent about characterizing and tagging entities on Bitcoin, on the Bitcoin blockchain. And so they do acknowledge that there are a lot of omnibus wallets held by exchanges. And so they are not doing this completely naive analysis where they run the Ginny on sort of the Bitcoin UTXO set. They are taking into account the fact that wallets hold balances on behalf of people. So, that's the first thing a lot of people jump to. They did at least attempt to kind of characterize entities on the blockchain for the sake of their ownership analysis.
So what's your what's your net on this in terms of the validity of the critique, and then how to just broadly frame Bitcoin as an asset versus other types of assets?
So they find that intermediaries control about 5.5 million Bitcoins and that individuals hold about 8.5 million Bitcoins, which is sort of consistent with, I guess, my view. I think they're maybe underestimating the intermediated component. I think it's unlikely that these academics have access to the best characterization data. I would say only the blockchain analysis firms have really good characterization data because they build their data sets in kind of a give to get model. And I would say they have proprietary, very good characterization. And so can two academics rebuild a data set that is worth billions of dollars, in the hands of Chainalysis from scratch on an academic salary? Absolutely not. I believe they're using sort of open source characterization tools like Wallet Explorer. They might be doing some machine learning stuff. They kind of don't provide a ton of detail on how they tagged up all the exchanges. They might have done some machine learning stuff to say this is what exchanges are like, and so we don't know what exchange this is, but it's behaving like one. But I mean, generally speaking, outside of exchange balances, is Bitcoin, relatively concentrated in ownership? I guess it's all relative. But yeah, it's probably more concentrated than the ownership of, say, stocks or dollars. Does this delegitimize Bitcoin? I don't think so. First of all, it's not proof of stake, so you don't get political power for owning more Bitcoin than someone else. The Bitcoin supply is becoming much more dispersed over time continually. You can see this on the blockchain. Coinmetrics has some great data on this. You can see how many addresses control, X amount of Bitcoin. You can also see more supply is constantly growing into the hands of smaller wallets, and less supply is being held in larger wallets. So these things are visible on chain. And lastly, if you look at any financial asset, you're going to find extreme concentration. So according to the Federal Reserve, as of today, 53% of equities in the US are held by the 1%. So I would say that's pretty concentrated. Yeah. So 1% of households control over half of all public equity in this country. So, it's not very egalitarian with regards to the equity market. Bitcoin is newer. It's only, 13 years old and sort of about 5 years into its financialization phase. And it's getting distributed into more and more hands. You always see older holders sell out over time and newer holders come in. So that's a naturally distributed force. So I would say all the trends are in absolutely the right direction. Is it perfect? No. But is it trending in a direction of less concentration? Absolutely.
Yeah. That was the point I was going to make, is if you looked at just equities when equities got started, it would have been probably a similar distribution. And, time will improve that Gini coefficient. It sounds like you think it was a well-done paper overall, though, in terms of just the rigor. I mean, it wasn't one of these like Tether scam papers.
Yeah, it's not completely idiotic. They at least made an attempt to incorporate omnibus wallets into their findings. They are not going to be able to compete with the Chainalysis in terms of the quality of data.
Yeah.
But they did make an attempt. All that said, I think the WSJ's take is like needlessly hysterical. And I don't really see it as a headline item. I mean, you don't see people complaining about the concentrated ownership of Tesla or whatever.
Yeah.
Or Apple, which is a bigger stock and I'm sure is held by fewer individuals than Bitcoin. And, here's the thing on the trend. So Bitcoin is in a dispersive trend, and proof of work helps there as well, because it means that new issuance has to be kind of sold off by miners. So that's great, right? Equities, on the other hand, are on a highly concentrative trend. When the Fed, and I'm using equities as a proxy for wealth, because wealth inequality has been growing. In 1990, when Fred started collecting the data, the top 1% controlled 40% of equity value in this country. Today, it's 53.8%. So, just look at yourself in the mirror here, legacy financial system defenders, because the financial system itself, financial assets are highly, highly concentrated and getting more concentrated in the hands of the wealthy. That is the direct effect of QE, right?
That's right.
QE increases asset values, and who owns financial assets is the rich. So I'd love to see that critique extended to all financial assets.
Yeah. Well, that makes sense. Well, why don't we move on to a couple just regulatory things here. Elad Roisman, I don't know if this is good news or not. So he's a SEC commissioner. He's on the other side of the aisle from Gary Gensler. He announced that he will step down in January, and that's ahead of when his term ends, which is 2023. He has been publicly disagreeing with Gensler for a while around things like just the overall agenda and resource allocation. So it doesn't strike me as a great thing that Gensler might get a shot to be influential around his replacement.
Yeah, I think the SEC is set up such that you have 3 commissioners from the majority party and 2 from the minority, if I'm not wrong. And Roisman as a Republican means that I think he'd have to be replaced with another Republican. So unclear as to whether Gensler would be able to find a Republican that really aligns with his very interventionist agenda. But an interesting move. And what are the odds that Roisman joins a crypto startup. I'd say pretty high.
I mean, I think that's fine if Roisman wants to do it, but it's like the Jay Claytons and Gensler will join a crypto startup when he's done. It's like these guys are just so disingenuous when they're in the seat and then they just go grab that cash when they leave.
Well, the way I see it is there eventually won't be any regulators left that haven't helmed a crypto startup. So we're just slowly capturing all of them.
I guess, but I don't know. It's like you're capturing them on the wrong side, right?
No. It's the implied prospect of joining a crypto startup that warps their decision making. Look, I'm not saying it's a good thing necessarily, but that's how it works in this country.
I guess. The other SEC news is Terraform Labs, which is the company behind Terra and behind Mirror. They're founded by Do Kwon, is the founder there. So him and the company have filed a motion basically seeking to oppose the SEC's efforts to compel them to comply with a subpoena. That was the subpoena that was actually served at the Masari conference back in New York earlier this year. And it looks like part of the motion here is that they're saying that, hey, they're not based in the US. And they're also saying that the SEC filed for that subpoena under like a bad process. And so they filed a civil suit. They're protesting the motion and we'll see. But you haven't seen entrepreneurs get this aggressive necessarily against the SEC. So I'm very eager to see what happens on this case.
Yeah, maybe this is going to be the foundation of an international incident between Korea and the U.S.
You think
It'd be interesting if Korea stepped up and started to defend their blockchain ecosystem from the SEC. That would be kind of an interesting outcome.
Yeah. Hey,
but
why not?
Who knows? Yeah, it's kind of interesting to see the gulf between, really aggressive statements made by the SEC and then their actual ability to alter real world outcomes and intervene.
Well,
which
here's the thing.
Historically has been lacking.
Yeah, I mean, here's the thing. The SEC needs to go out and like win these cases, right? So it's one thing to issue the subpoenas and to saber rattle all of these DeFi entrepreneurs, but ultimately they're going to have to go win the case. And we'll see. I mean, I guess the Ripple one would be the one to watch, and they'll probably win that one is my guess.
Look, this is not an endorsement of Ripple, but I am oddly bullish on their ability to prevail. And my reasoning is that the SEC, I think I've said this before, they're like a predator with finite resources, like a leopard on the savannah.
Okay.
And there's only so many, or like a cheetah, maybe, like a cheetah on the savannah. And there's only so many times they can go after the antelopes, because they're expending their own energy trying to hunt down their prey. And the more difficult it gets, the more reluctant they're going to be to go after the biggest, healthiest antelopes.
Yeah, it's not a bad comparison.
And the SEC, they've lost cases before.
They have
lost that
cases,
SEC capital case.
Yeah.
I could see them losing the Ripple case. I think Ripple's going with a strategy of really trying to compare Ripple to Ethereum and saying, well, hang on, why did you give Ethereum this carve out, and pointing at the ways that Ethereum had these key points of centralization, not to make the point that they are the same, but I think that's kind of an interesting rhetorical strategy Ripple has undertaken.
Well, I guess it's also possible that the SEC ends up fighting a two-front war here. So you're fighting the war against the VCs and the entrepreneurs who are pushing for these open networks. And then you're fighting Lummis and this new bill that is basically going to take away power from the SEC around cryptocurrency, it looks like. So it'll be a busy time over at the SEC. And, maybe Roisman here is, this comment around resource allocation or this, I don't know, it's not a quote, but maybe people at the SEC are saying, hey, we don't really agree with the way we're being managed. And maybe that's a third front of this war here for Gensler.
Yeah, that is a good point, that the SEC ultimately serves at the pleasure, I guess, of the executive, but they still rely on Congress to set their mandate. And there's limits to their power. And if Congress decides that they want to do more through legislation as opposed to interpretation, which is what the SEC does, that might put some handcuffs on them a little bit. So we'll see what Congress is willing to do, whether they're willing to stick up for the SEC in their new aggressive mandate, kind of like how the IRS has now been empowered by Congress, or if they're seen as kind of misfiring.
But how about just even, so I agree with that, but also what about just people that work there? Like a CEO of a business has absolutely no power if the people that are on the front line just don't want to do what they're directed and completely disagree with the mission. And so, my sense is that there's some people over at the SEC that just see Gensler as this nakedly ambitious person that's trying to become the Treasury Secretary, and he's working them to the bone around things that they don't agree with. And so I think this is a multifaceted situation here. So I it's a complicated puzzle here for Gensler.
That's right. Will there be a revolt at the SEC?
Well, because think about it. If you're at the SEC, you're a lawyer, for instance, you know about crypto. You could go become the general counsel at any number of crypto companies, and you could be making, $500,000 a year. It's probably more than you're making at the SEC. So these people have extraordinarily high impact in this industry. If you know anything about the law and crypto at that Venn diagram, you'd be making a killing right now. So these people have tremendous market power in a way that they don't have in other industries that historically the SEC has looked at. I mean, like a broker dealer, lawyer, like whatever, there's a bunch of those, like not to take anything against them, but like that's a seat you can fill. People that actually understand DeFi and cryptocurrency, there's not a lot of those.
Yeah, I mean, speaking from experience, my co-author on my DeFi paper, Linda Zhang, is ex-SEC, and now she works in the crypto industry. So that's kind of the one-directional flow.
Yeah, so like, why are you sitting there listening to someone who's just there making you work 80 hours a week so that you can take down some like venture-backed startup so that your boss can end up as Treasury Secretary? It's like, that's the discussion I think that's going on right now.
Well, Matt, I think some of these people are driven by more than money. I think certainly if you work at the SEC, your motives are not purely financial.
No, they're not.
By a sense of justice.
But a sense of justice around, like, these are people that actually, some of them probably believe that what this industry is doing is positive. We're talking about taking money in a self-sovereign way, giving people free speech over their money. We're talking about making people less reliant on banks and intermediaries. We're talking about people taking possession of their private keys and taking possession of their personal data. Like, there's a lot of things here that people are very ideologically aligned on around, like, the positives of the cryptocurrency system. And if your job is to just go kneecap people because, hey, you cut a corner on a fundraise, like, I don't think people are aligned with that.
Well, this is a fiery Christmas Eve sermon right here, Matt.
I mean, we're going on minute 56 here. We're
this is one of our longest roundups. It's Christmas and we're fired up.
Hopefully, no one at the SEC is listening to this at minute 56, but that's the hot take.
So, speaking of which, we are introducing a push to get some more policy folks on the podcast. So, if you work on the Hill or are in Congress, you're welcome to come on the show. Let's talk about the Lummis bill.
Let's talk about it. I will be doing a podcast early in the new year with a very exciting group of people that are really pushing for change. I'm just going to leave it at that.
I'm going to try and bully Niraj Agrawal into coming on. He never really wants to do the podcast, so
I would love to have him on the podcast. He's too busy in his industrial kitchen.
Yeah, nice kitchen. So yeah, Brink Nation, harass Niraj and make him come on the show.
All right, so I think that's a good place to leave it. I hope everyone has a safe and healthy holiday, but this was one of our longer episodes.
Yeah, Merry Christmas, Happy Holidays. Thank you for being with us for another year, Brink Nation. And for those last minute holiday presents, the merch store is open and ready to take your orders.
Merch store is open. You can also just buy crypto and gift that. It's a great gift. All right, everyone. We'll see you on Monday.